Welcome back, everyone. This is the gold market review for the 9th of November. Gold jumped to a new monthly high in the past sessions, reaching now levels previously seen back in September. Gold's three latest daily sessions consisted of consecutive bullish movement that was very evident. Gold traders leave behind an interesting week and look ahead to another one of similar importance. In this report, we will be looking into gold's price action and the fundamentals driving it, while at the end, we will be closing with a technical analysis providing important levels for traders to be mindful of. Enjoy the report. Starting with a short briefing of the previous week, which included two key economic events for the US economy. First, the latest FOMC meeting where the committee kept its interest rate at 0 to 1/4% while announcing simultaneously it would start tapering its QE program moving into December. Even though gold was down in the hourly sessions prior to the meeting, as we got closer to the release, the precious metal started rising and formed a trend that would persist in the latest sessions and in the next week. The Fed's comments on improved economic circumstances, especially for the sectors most adversely affected by the pandemic, may have formed a risk-on sentiment for investors, as along with gold's price rising, the major US stock markets were also up. Also, during the previous Friday, the US employment report sent very positive signals for the labor market, with a bigger than expected NFP figure and a larger drop of the unemployment rate towards the desired target. Yet, the greenback took a dive after the release of the figures, which may have pushed gold prices even higher, making it the most profitable day so far in November for the metal. Characteristically, we must note that the USD reached a new yearly high in the past week, while gold prices are also on the rise. Thus, we could also note the adverse relationship between gold and the USD is very questionable for the time being, and traders using this method as an approach to place orders should be cautious. In the days ahead, a number of financial releases are available for gold traders to use as possible indications for price direction. First, the most important are the US inflation rates for October that will be released on the 10th of November and are expected to keep gold traders busy. Gold has traditionally been used as an instrument for higher prices, thus we expect gold prices to develop volatility before and after the release. In our view, if the US inflation rates are to accelerate, then gold's price may experience some bullish tendencies. On the same day, and at the same time, we also get the weekly US initial jobless claims figure, which is a reading worthy of keeping in mind, as gold could be sensitive to any readings beyond expectations. In the following week, traders will have a very busy day on the 16th of November, as the US retail sales and the industrial production rates for October are imminent. As a final comment, very interesting, where Fed Vice Chair Richard Clarida's comments on the 8th of November as he spoke on the prospects for the US monetary policy. Clarida referred to the economic conditions reaching levels in line with the committee's projections. Then, rate hikes could be a possibility within year-end 2022. However, the speed of the recovery may be enhanced in our view, as in the next month circumstances may be more favorable as the pandemic subsides. Moving now to gold's technical analysis, please note this is gold's 4-hour chart. As gold has managed to break above the S1 1815 level, turning it into a support, traders may now be focusing at higher lines, possibly at the R1 1835 resistance level. This opinion can be based on the fact that gold remains in an upward trend line since the 4th of November until the present moment. A possible move above the R1 could make way for the R2 1845 to be tried, while this level has not been come across since June. At the top, we tend to keep in mind the R3 1860 line. A test of either the R2 or R3 level would signal a breach above the highest price tested for the past months and can be used as a strong bullish indication. On the contrary, if traders support a more bearish scenario, then we could consider the S1 1815 support as the first level to be tested, while a continuous selling momentum can send the price action to our S2 1800 round number level. A breach below the S2 could change our bullish view to a sideways one, while in that case the S3 1785 can also be considered as a target. For the time being, the RSI indicator below our chart runs across the 70 line, implying the buyers far exceed the sellers. Yet the stabilization there can also invite some temporary bearish tendencies in the very short term. In this case, the range between the R1 and the S1 can be used by traders. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.